Okay, let's just jump right in. What if the traditional way you've been told to invest, just tracking a big market index based on company size, what if that isn't the only game in town? Or maybe, just maybe, not even the best way to think about your portfolio.
Right. What if there are these hidden nutrients in the market, these fundamental drivers of return that you could actually target on purpose?
Exactly. Moving beyond just saying stocks or bonds. And that's really the question that brings us here today. Welcome, everyone, to the deep dive.
We're about to really get into it, wading through a whole stack of source material. We've got articles, research papers, insights from big players like BlackRock and MSCI, even commentary on, well, us, investors, and how we behave.
And it's all focused on this powerful idea called factor investing, and specifically how it's showing up in things like Smart Beta ETFs right here in the U.S. market.
Yeah, think of it as a journey to understand what's really going on beneath the surface of market performance. Our sources are pretty rich with the history, the theory behind it all, and also the really practical side of looking past those simple asset class labels.
Finding the real drivers of risk and return.
Precisely.
So our mission for this deep dive is, I think, crystal clear and pretty important for anyone investing. We want to help you understand what these factors and smart beta strategies actually are, how they're kind of a big step beyond that standard market cap weighting we talked about. What are the potential upsides? What are the risks involved?
And maybe most importantly.
Yeah, what absolutely crucial things do you need to think about if you're considering these kinds of strategies for your own money?
It's about getting you up to speed, basically. Cutting through some of the jargon to give you a solid footing in this, evolving part of investing.
Think of it like getting the ingredient list for your investments, right? So you can be more precise about building your portfolio, moving from just buying the food to understanding its core nutrients.
That's a great way to put it.
Okay, so let's start right there with that nutrient idea. What exactly are factors? And why should anyone from a big institution down to someone saving for retirement really care about them?
Okay, so at their heart, factors are these fundamental historically persistent drivers of investment returns. They're broad, systematic things that help explain why different assets perform differently over time.
And the sources stress, they're pretty intuitive concepts, actually, even if the term factor investing sounds a bit, technical.
Right. They've become quite well understood in the market.
And I love the analogy the source material uses to make this real, comparing factors to nutrients in food.
Yeah, that's a good one.
Like, milk, steak, veggies, they all look different, but underneath they have fat, protein, carbs, vitamins.
The basic building blocks.
Exactly.
Yeah.
And different asset classes, stocks, bonds, private equity, whatever. So they also contain these common underlying economic risks or investment characteristics. Factors are like those fundamental nutrients.
So it lets you dissect things, analyze the real sources of risk and return in your portfolio, rather than just relying on labels like U.S. large cap growth or something.
Right. It cuts through those traditional boxes we put investments in. It's about the underlying economic stuff.
Precisely. It gives you a more, let's say, granular way to understand what's really driving things, which leads to a pretty critical question.
Which is?
If these factors are known, persistent drivers of return, why do they keep existing? Why doesn't the market just, arbitrage them away instantly?
Good question. And the sources give us a few compelling reasons why they stick around, rooted in how markets work and, frankly, how we humans behave.
Okay, like what?
Well, first up is the idea of risk premia. Basically, investors get rewarded for taking on certain types of risk that aren't fully captured just by owning the whole market.
Okay, give me an example.
Think about the value factor, buying stocks that look cheap based on fundamentals, like earnings or book value. Often these are companies that might be, struggling a bit, facing more uncertainty.
Wait, they're cheap for a reason, maybe.
Exactly. So investing in them means taking on more business-specific risk. And investors, logically, demand extra compensation for taking that extra risk over the long haul. That compensation shows up as a long-term return premium for value stocks. It's a return for bearing that specific risk.
Okay, that makes sense. Risk equals reward, essentially. What else?
Another big one is what the sourcing calls structural impediments. These are like real-world frictions or constraints in the market that stop things from being perfectly efficient, like in academic models.
So real life getting in the way of theory.
Pretty much. Things like transaction costs, taxes, rules against short selling for many investors, betting against expensive stocks, or even just long-only rules that stop many funds from selling stocks they don't own.
Right, practical hurdles.
These all act as barriers. They stop even savvy investors from instantly jumping on every little factor mispricing, which allows these premiums to, hang around over time.
I see. So the market isn't perfectly smooth.
Not even close. And then there's maybe the most interesting one, behavioral biases.
Ah, the human element. Psychology.
Totally. This taps into how we often make, let's be honest, irrational decisions with our money. We're prone to biases, right? We chase stocks that have gone up recently, FOMO, fear of missing out, thinking the trend will last forever. That's momentum, basically.
Herd behavior.
Or we avoid cheap, unloved value stocks because they have bad news around them, or we're afraid of losses. We anchor to old prices.
Loss aversion, yeah.
These widespread psychological tendencies create these predictable patterns of mispricing that disciplined, systematic strategies can potentially exploit over the long term. You're kind of earning a premium by going against the crowd's emotional swings.
So it's a mix of rational risk compensation, market frictions, and our own behavioral quirks.
Exactly. And studying these factors isn't some new fad. Academics have been digging into this for, over 20 years? Longer, really.
Yeah, the foundational work goes way back. What we've seen more recently is taking these intuitive styles like hunting for value or quality companies, things good active managers have always done, and formalizing them into this structured, researched factor framework.
And adoption has really taken off, hasn't it? Especially since the late 2000s, maybe post-financial crisis. The sources mention work with the Norwegian Sovereign Wealth Fund around 2009 as a kind of turning point.
Absolutely. That was a big moment when large, sophisticated investors started really thinking about their portfolios in terms of these factor exposures, not just sticking to asset class buckets.
It represents a fundamental shift. There's a great quote in one source from a Dutch private bank.
Oh, yeah, I remember that one.
They said their philosophy is now all about, are we exposed to the right factors, whilst previously it was still about stock selection, alpha, and these types of things.
That says it all, doesn't it? Moving away from just hoping your manager picks the right stocks, that's the alpha hunt, towards a more systematic focus on getting exposure to these known drivers of return, the factors.
Okay, so if factors are these fundamental nutrients, and we have some idea why they persist, how does the average investor actually get access to them? Systematically, transparently? That's where Smart Beta ETFs come in, right?
Right. Smart beta strategies, and often delivered through ETFs here in the US, are basically a way to capture these proven return drivers using rules-based, transparent strategies.
They're like benchmark-driven versions of factor strategies, usually long-only, focused within an asset class like stocks.
And the key difference, why they call it smart beta, is how they move away from that traditional market capitalization weighting.
Explain that again quickly. Market cap weighting.
Sure. Most big indices you hear about, S&P 500, total stock market, they weight companies based on size, share price times, shares outstanding, bigger company, bigger weight.
Seems logical. Reflects the market's view.
It does, but the sources point out a potential problem. Concentration risk. If the biggest stocks get way overvalued or just hit a rough patch, they can really drag down the whole index because they have such a large weight.
So too many eggs in the biggest baskets, potentially.
Exactly. Smart beta strategies deliberately use alternative weighting methods. They're designed to tilt away from just market cap and towards those factors we want exposure to, trying to be smarter than just passively following size.
Which naturally leads to that question, is this stuff active investing or passive investing? The sources seem to tackle this head on.
Yeah, it's a common point of confusion. The best description, really, is that it's somewhere in between.
Okay.
It's not purely passive, like just buying a market cap index fund that mirrors the market, warts and all. Smart beta is active in the sense that it tries to improve risk-adjusted returns by deliberately targeting specific factors. There's an active decision, an intent to deviate from the market to capture something specific. But it's very passive-like in how it's done. The rules for picking and weighting stocks based on the factor like value or low volatility are totally transparent, systematic, rules-based. Once the rules are set, the ETF just follows them automatically.
So not much day-to-day manager discretion needed.
Right. Which usually means lower fees and the ability to handle more money compared to traditional active managers who are making judgment calls all the time.
So the goals of Smart Beta then are pretty clear. potentially improve returns over the long haul, maybe reduce risk depending on the factor, and enhance diversification by looking at things differently than just market cap.
Exactly. Those are the main aims highlighted in the materials.
But we absolutely have to stress that point again about factors being cyclical.
Crucial point, yes.
While they've historically been rewarded over the long term, decades even, their performance is definitely not smooth sailing year to year. Any single factor can have great years or terrible years compared to the market.
And the theory suggests you only get that reward by sticking with it over that long term through the inevitable ups and downs. Patience is key.
Absolutely paramount. We'll come back to why that's so hard later when we talk investor behavior. But first, let's get specific. What are these key factors that Smart Beta ETFs try to capture, especially in the stock market, based on research from places like MSCI?
Okay, yeah, let's name the nutrients. Firms like MSCI identify factors that clear some pretty high hurdles. They need a solid theoretical reason for why they should persist long term.
Right, not just a statistical fluke.
Exactly. And they need to have shown a systematic risk-adjusted return premium historically, meaning over time they've offered potentially more return for the risk taken, or maybe similar returns but with less risk compared to the broad market.
These are things that seem tied to bigger economic forces, market structures, or those behavioral patterns we mentioned.
And yes, worth saying again, while they've outperformed over long stretches historically, they absolutely go through periods, sometimes long periods, of underperformance. You have to expect that.
Got it. So let's walk through the main ones the sources highlight for equities, maybe touching on why they might work.
Sounds good. First, probably the most famous one, value.
Buying cheap stocks.
Pretty much. Capturing excess returns from stocks with low prices relative to their fundamental value. Things like low price to book, low price to earnings, high dividend yield. The idea is the market might be too pessimistic about these out-of-favor companies.
Okay. Then there's small size or the small cap factor.
Right. The observation that smaller companies have, historically, tended to outperform larger ones over very long periods. The measure is simple: market capitalization.
Why might that be?
Could be several reasons. Maybe they're riskier, harder for big institutions to buy and analyze, less covered by analysts, creating a risk premium or maybe an information advantage for those who look closely.
Makes sense. What's next?
Low volatility. This one's interesting because it's a bit counterintuitive. It captures excess returns from stocks that have historically been less volatile, less risky than average.
Wait, less risky stocks do better? I thought more risk meant more return.
Over the long term, surprisingly, low volatility stocks have often delivered similar or even better returns than high volatility stocks, but with significantly less bumpiness. Measures include historical standard deviation or beta, how much a stock moves with the market.
Huh. Maybe stability pays off.
Could be. Then there's high yield, focusing on stocks with higher than average dividend yields. Pretty straightforward measure. Dividend yield.
Is that just a type of value?
Sometimes it overlaps, but the sources often treat it separately for its income focus in association with maybe more mature, stable companies returning cash to shareholders.
Okay. Keep going.
A really big one these days is quality. This aims to capture returns from stocks with strong fundamentals, low debt, stable earnings growth, solid balance sheets, things that indicate a financially sound, well-run business.
So looking for companies that are just good.
Basically, yeah. Measures include things like return on equity, ROE, consistency of earnings growth, low debt levels, strong cash flows. The thinking is high-quality companies should be more resilient and perform better over the long term.
Seems logical. What's left?
Momentum. This is the tendency for stocks that have done well recently to keep doing well in the near future, and vice versa for stocks that have done poorly.
So trend following.
In a systematic way, yes. Measures look at relative returns over the past 3, 6, or 12 months. This is often linked back to those behavioral biases, like investors underreacting to good news initially or jumping on bandwagons.
Right. And we should probably mention the academic heavyweights behind a lot of this.
Absolutely. Fama and French in the early 90s really laid the groundwork identifying market, size, and value factors. Then Carhart added momentum. That 4-factor model is still a benchmark.
And a key contribution of index providers like MSCI and the Smart Beta world is making these factor premiums accessible, right? Taking something that used to be mainly the domain of active managers, often expensive and opaque, and putting it into transparent, rules-based indices and ETFs.
Exactly. It's kind of democratized access to these potential return streams for passive investors or those using passive tools.
Okay, so we know the factors. How do they actually build these smart beta indices to capture them? It can't be as simple as just picking stocks with the right score.
No, it's definitely more involved. But the core principle, as we said, is that it's strictly rules-based, consistent, and transparent. No manager whims involved.
But there are trade-offs in the design.
Yes, a key one, especially for indices meant to handle lots of money, is balancing factor exposure versus investability.
Meaning?
Well, you could design an index to have the absolute maximum possible exposure to, say, the value factor. But that might mean holding a really concentrated portfolio, maybe including lots of small illiquid stocks that are hard and expensive to trade in large quantities.
Okay, so pure exposure might not be practical.
Right. So high-capacity indices prioritize investability. They focus on making it easy to invest large sums, keeping turnover low, which might mean accepting a slightly less intense factor exposure to maintain that liquidity and practicality. Providers often offer different versions depending on what an investor needs.
And within those high-capacity indices, how do they actually weight the stocks to get the factor tilt, if not just market cap? The sources mentioned a couple of ways.
Yeah, two main approaches described. First is the score-only approach. Here, a stock's weight is based only on its factor score, like its value score, or its low volatility score relative to all other stocks.
So the cheapest value stocks get the biggest weight, regardless of their company size.
Pretty much. This gives you high factor exposure compared to market cap. But it can make the index look very different from the broad market. And interestingly, if the factor score itself isn't strongly tied to company size, like maybe a stock's price volatility, this approach could end up overweighting smaller companies that happen to score well on that factor.
So you might get an unintended size bet. The source had an exhibit showing this for low volatility, right? The weights look totally different depending on the method.
Exactly. It highlights how the mechanics matter. The second approach tries to balance this. The score times market cap method.
Okay, how does that work?
Here, you calculate a stock's weight based on its market cap multiplied by its factor score relative to the sum of that for all stocks.
So size still plays a role, but it's adjusted by the factor.
Right. It leans closer to market cap weighting naturally. It gives more weight to larger companies that also have the desired factor characteristic. This generally increases the index's capacity, makes it more investable, and keeps it from deviating quite as extremely from the overall market compared to the score-only method.
And providers also use other metrics behind the scenes to make sure these things are actually tradable, right? Liquidity, ownership, limits.
Oh, yes. Lots of investability metrics go into the construction free float, trading volume, concentration limits, managing how much the index differs from the benchmark active share. It's quite engineered to work in the real world.
Okay, factors identified, indices built. Let's get back to the big picture. Why should an investor bother with all this? What's the real rationale for using factor investing, and how can it actually help in a portfolio?
Well, the core idea, again, is getting that deeper understanding of what's driving risk and return, moving beyond just asset class labels to see the underlying economic engine.
And that understanding helps with
Improved risk management. When you analyze your whole portfolio, maybe you have several different funds or managers through a factor lens, you can spot hidden overlaps or, importantly, unintended bets.
Like you think you're diversified, but all your managers are unknowingly loading up on the same factor.
Exactly. Maybe they all love momentum stocks right now. A factor analysis can reveal that concentration, which could be a hidden risk if momentum suddenly turns sour. It helps you see the real bets you're making.
Okay, seeing the hidden risks. What else?
Ultimately, the goal is to build more robust, truly diversified portfolios that give you a higher probability of achieving your long-term goals. One investor in the sources put it nicely, saying, Smart Beta helps them build the more exact allocation we want. It means you get better risk-adjusted outcomes and you have fewer surprises. It's about intentionality.
Building the portfolio based on desired outcomes, using factors as the ingredients.
Right. This leads to what the sources call an outcome-oriented approach. You accept that individual factors will be cyclical short-term, but you believe in their long-term potential based on risk premia, structure, or behavior.
And a key strategy then becomes diversifying across factors.
Definitely. Just like you diversify across asset classes, diversifying across different factors, value, momentum, quality, low volatility, can smooth out the ride. Their performance cycles often don't line up perfectly, so combining them can potentially reduce the volatility of any single factor and keep you on track.
The sources gave some examples of how you might combine factors for different goals.
Yeah, really useful illustrations. For someone focused on risk reduction, a defensive portfolio might combine minimum volatility, value, and quality. Lower risk, maybe some stability from value, robustness from quality.
Or for more balanced exposure.
A balanced portfolio might mix size, min-vol, momentum, value, and quality, casting a wider net across potential return drivers.
And for someone willing to take more risk for potentially higher returns.
Maybe a dynamic portfolio focusing on size, momentum, and value, trying to capture more cyclical opportunities, likely with more tracking error versus the market.
And the charts in the source material showed these different combos really do behave differently over time, right? Different performance paths, different levels of volatility compared to just owning the whole market.
Exactly. It demonstrates you can potentially tailor your risk-return profile using factors.
So how are people actually using Smart Beta ETFs in practice?
Several ways. You can use them to implement a specific view, and maybe you think value is cheap right now, so you buy a value factor ETF.
Or maybe replace an active fund.
Yeah, that's common. If you find a Smart Beta ETF gives you similar factor exposure to an active fund you own, but with lower fees and more transparency, it could be a good substitute or complement.
And just managing your overall factor exposure, tilting toward factors you like or hedging ones you don't.
Right. And there is that interesting case study about CLS investments.
Using Smart Beta ETFs as a liquidity sleeve.
Yeah, for their core factor positions that were maybe in less liquid vehicles, they use the ETFs to make quick adjustments around their target factor weights. And their use of these ETFs grew significantly, showing how they can be integrated into sophisticated portfolio management.
Now we've mostly talked equities, because that's where Smart Beta is biggest right now. But the sources mentioned it's popping up elsewhere.
Briefly, yes. In fixed income, traditional bond indices are swamped by interest rate risk. Smart Beta tries to diversify that, targeting things like credit risk or liquidity risk more explicitly.
Getting beyond just duration.
Exactly. And in commodities, return comes from the spot price, the roll yield from futures, and collateral return. Smart Beta approaches there try to understand and potentially isolate those different return sources for more dynamic strategies.
So factor thinking is spreading.
It seems so. Equity is most developed, but other areas might see big changes as this framework gets applied more broadly.
Okay, this all sounds pretty positive. Potential for better returns, managing risk, transparency, lower costs, like a magic bullet.
Well, not so fast. Like any strategy, Smart Beta comes with its own set of risks and challenges. And maybe the biggest one, as one source starkly puts it, is us, our own behavior.
The biggest failure in investment management, they called it. What are the key risks we need to understand?
First, and we keep saying it, but it's critical, short-term cyclicality. Factors will underperform the market, sometimes painfully for long stretches. It's part of the deal, theoretically, but psychologically, very tough to handle when your strategy is lagging.
Then there's implementation. Getting those theoretical factor returns in the real world isn't free.
Absolutely. Trading costs, bid-ask spreads, market impact, they all chip away at returns. And how a Smart Beta product is designed really matters here. How concentrated is it? How much does it trade? Turnover? Are the stocks liquid? These affect the real-world costs.
So the management fee isn't the whole story. While Smart Beta ETFs are usually cheaper than active funds, they're typically pricier than plain market cap ETFs. And those hidden trading costs can narrow the gap with active further.
Right, which leads us to that really sobering point about the investor returns gap.
The difference between what the strategy earns and what the investor gets.
Exactly. And it's often called the biggest failure because historically this gap is significantly negative. Investors tend to earn less than the funds they invest and report.
Why? Because we do dumb things.
Bluntly, yes. Poor timing. We chase performance, we buy after a strategy has done well, buying high, and we sell after it's done poorly, selling low. We get whipsawed by our own emotions.
Buying high, selling low. The classic mistake.
And the sources cite studies showing this gap can be huge, like 1.3% per year for value funds in one study, over 2.2% per year for large cap funds versus the S&P 500 in another. Investors leaving significant money on the table due to bad timing.
Wow. And here's the kicker. How does Smart Beta fit into this? could it make it worse?
Paradoxically, yes, it could if investors aren't careful. Because smart beta strategies deliberately tilt away from the market, they often have higher tracking error relative to familiar benchmarks like the S&P 500.
Meaning their performance can look quite different from the overall market's performance.
Right. Those deviations, both the good periods and the bad periods, are much more noticeable. And the sources suggest this higher visibility can actually trigger those poor timing decisions more easily.
So when your smart beta fund lags the S&P 500 for a year, it's really obvious, and maybe you panic sell near the bottom.
Precisely. Or you pile in only after it's had a huge run, right when the factor might be getting expensive.
The implications are pretty stark then. One study mentioned suggested that if smart beta funds suffer the same kind of investor return gap seen in active funds,
then historically, only a small fraction, maybe around 21% in that study, would have actually delivered positive excess returns to the investor after factoring in costs and that behavioral gap.
meaning most investors might have been better off just sticking with a cheap market cap index fund, despite the theoretical appeal of the factor strategy.
If they couldn't stick with it, yes, that's the sobering reality the sources force us to confront.
Okay, what are the risks? Crowding?
Yeah, that came up. An investor from an Asian sovereign wealth fund raised the concern. As factor investing gets more popular, could these factors become crowded trades? If everyone piles into the same systematic strategies, could it dilute future returns or cause sharp sell-offs if everyone tries to get out at once?
So, monitoring the health of factors, how expensive they are, how much money is flowing in, becomes important.
For sophisticated investors, yes. And for everyone, there's the challenge of just choosing the right strategy. There are so many providers, so many factors, so many ways to combine them. Picking the right one for your goals isn't trivial.
It requires homework.
Definitely. And finally, let's face it, while it's rules-based, there is a layer of complexity. Understanding the factor definitions, the construction rules, how it might behave, it takes more effort than just buying a total market index.
Okay, so clearly, navigating this space successfully takes more than just knowing the theory. It requires a plan, discipline, and the right mindset to avoid those behavioral pitfalls.
Absolutely. The sources actually lay out a pretty useful 6-step process for investors thinking about smart beta. It provides a good framework.
Let's walk through it. Step 1.
First and foremost, clarify your investment goal. What are you trying to achieve? Growth, risk reduction, income, diversification. Your goal dictates everything else.
Makes sense. Step 2.
Verify the merit and investability. Does the research really back up this factor long term? And is the specific product you're looking at well-constructed, liquid, and able to handle your investment size? Due diligence, basically.
It's 3.
Evaluate potential performance in different market regimes. How might this factor strategy behave when growth is strong? Or inflation is high? Or during a recession? Not for market timing, but for setting expectations and building convictions so you don't panic later.
Okay.
4, understand the strategy's construction rules. Really dig into how it picks stocks, how it weights them, how often it rebalances. The details matter. Remember the score only versus score times market cap difference. Know what you're buying.
Got it. 5.
Consider it in the context of your existing portfolio. How does this fit with everything else you own? Does it add diversification? Does it maybe unintentionally double down on a factor exposure you already have? Look at the whole picture.
And finally, 6.
Compare the costs. Look at the expense ratio, sure, but also try to gauge the impact of trading costs based on turnover and liquidity. Find the best value, all in.
That's a solid checklist. And underlying all this seems to be a call for a different kind of conversation, right? Between managers and investors.
Yes, the sources argue strongly for shifting the focus away from just strategy paper returns to actual investor outcomes, which means tackling that investor returns gap head on.
And maybe the transparency of smart beta can actually help here. Build conviction.
That's the hope. Because it's systematic and rules-based, when it underperforms, you can understand why based on the factor exposure and the market environment. It's not a black box manager making mysterious decisions. That transparency can help investors stick with it.
But it still requires that leap of faith beforehand.
Absolutely. You have to truly believe in the style's long-run potential before you invest. And you have to internalize that the ride will be bumpy. Staying the course through the down periods isn't just advice. It's fundamental to actually capturing the potential long-term reward.
So you almost need to institutionalize being contrarian. Fight your own instincts.
Yeah, that's a great way to put it. Institutionalizing contrarian behavior. The sources suggest using tools to help fight performance chasing, like using relative valuation.
How does that out?
Instead of just looking at recent returns, also look at how expensive or cheap a factor is compared to its own history or compared to the overall market. Is the value factor trading at a deep discount right now, even though it's lagged? Is momentum looking stretched and expensive after a strong run?
So valuation adds context to performance.
Exactly. And this provides a rational basis for systematic rebalancing. You methodically trim strategies that have done well and become expensive, and you add to strategies that have lagged and become cheap.
Buying low, selling high.
Yeah.
Based on valuation, not just recent performance.
Precisely. That disciplined contrarian rebalancing is key to overcoming that behavioral gap and actually harvesting the factor premia over time.
Okay, let's try to pull this all together. Key takeaways from this deep dive into smart beta ETFs and factor investing.
Well, we saw smart beta is about moving beyond market cap, targeting these fundamental drivers factors like value, size, quality, momentum, low vol, yield, these nutrients.
Right, it's a blend active intent to capture factors, but passive like rules-based implementation, often transparent and potentially lower cost than traditional active.
Offers potential benefits, return enhancement, risk management, diversification, cost savings, transparency. Powerful tools for building portfolios tailored to specific outcomes using factor combinations.
But there are challenges. Factors are cyclical. They will underperform sometimes for long periods. Implementation isn't frictionless. Costs matter.
And the biggest hurdle might just be us, our behavior. That investor returns gap caused by poor timing, chasing performance, selling low. It can destroy the benefits of even a great strategy.
So the bottom line from the sources seems clear. Smart Beta is a powerful research framework. Systematic, transparent access to potential return drivers.
But its success for you depends less on the fancy index rules and more on your understanding, your long-term conviction, and crucially, your discipline to stick with it through thick and thin, avoiding those costly timing mistakes. Maybe using tools like valuation-aware rebalancing helps.
It's not enough to pick a winning strategy on paper.
You have to actually execute it, stay invested to realize the potential.
Which brings us back to that provocative thought. If the biggest failure is us undermining our own returns, could the very transparency and systematic nature of smart beta, if combined with a disciplined long-term approach, actually help us behave better? Could it finally help bridge that investor returns gap?
That really is the multi-billion-dollar question for anyone considering these strategies, isn't it?
It certainly is something to really mull over as you think about your own investments.
Indeed.
Well, thank you for joining us on this deep dive into smart beta ETFs and factor investing. We hope this exploration gives you a clear picture of this important area and maybe sparks some ideas for your own investment journey.